The current live trading price for Rezolve AI PLC on the NASDAQ is $2.77, reflecting an intraday increase of $0.02, or about 0.73% as of 12:36 p.m. EST on Tuesday, November 18, 2025. Now, the common expectation for a stock that's trading this tightly, especially one that has been as volatile as Rezolve AI has over the past few months, is that the small upward tick is simply noise, a minor dead cat bounce in a larger, sustained downtrend. That is the expectation. The immediate reality, however, is that this minor upward movement is happening on the heels of a significant and aggressive round of institutional buying over the past few sessions that retail investors are largely overlooking, suggesting a quiet accumulation is underway despite the loud negative market narrative. The fact that the stock is holding above its daily low of $2.69, while high-frequency trading accounts for a disproportionate share of the recent volume, hints at a calculated defense of a key price level, which is a detail that sharply contrasts with the prevailing belief that this stock is simply being left for dead. The general market sentiment surrounding Rezolve AI PLC, ticker symbol RZLV, has been dominated by skepticism, which is not unfounded given the stock's roller coaster performance this year. After soaring to a 52-week high of $8.45 in September, the shares have collapsed by nearly two-thirds, settling into the sub-$3 range we see today. The narrative is straightforward. A classic post-SPAC or post-uplisting dilution event, coupled with a persistent failure to deliver meaningful revenue to match the hype of its agentic commerce platform. This expectation of continued price decay is what many retail traders and even some institutional short sellers are basing their positions on. They see a high burn rate tech company with a business model that, while forward-looking, still lacks the financial proof points to justify a billion-dollar-plus valuation, even with the recent price decline. The contrarian view, the reality hidden beneath the headlines and the massive price depreciation, is rooted in the strategic acquisitions and management appointments the company has made. Over the past few weeks, the news flow has been consistently focused on bolstering the corporate structure, including the announcement of a former Microsoft executive to lead the national sales rollout, and the October acquisitions of entities like Subsquid for data and SmartPay for digital asset payments. This activity is not the behavior of a company circling the drain. It's the methodical assembly of a platform capable of supporting a full-scale commercial push. The key tension is that the stock price is discounting the execution risk before the market has seen the full fruits of this strategic assembly. The expectation is that AI is still a buzzword for them. The reality is they are building the underlying plumbing for what they call agentic commerce, which is essentially the next generation of automated digital transactions. Their platform is designed to integrate this capability directly into retailers' and manufacturers' existing apps and systems, aiming for frictionless one-click or zero-click transactions. They operate on a subscription or per-transaction fee model, meaning their revenue scales not just with the number of clients, but with the volume of high-value transactions their AI facilitates. The old expectation was that this was a futuristic concept. The reality is that the underlying technology is being commercially tested now, and the recent acquisitions are specifically designed to solidify the payment and data infrastructure needed for these agents to function reliably at scale. This brings us directly to the short-selling dynamics, which are absolutely critical to the RZLV story. The stock has been under significant short-seller pressure, a common occurrence for volatile, high-growth, low-revenue AI firms. As of the last published NASDAQ data, the short interest stood at over 12 million shares, representing a substantial percentage of the float, likely sitting near or above 10%. The days to cover figure, which measures how long it would take for short sellers to buy back all borrowed shares based on average trading volume, has recently been around 1 day. While a single day to cover ratio is low and doesn't suggest an imminent short squeeze, the absolute number of shares shorted has been steadily increasing since the summer, which is a major signal. The motive for these shorts is pure valuation arbitrage, betting that the market will eventually price the company based on its meager current revenue and hefty operating losses, ignoring the implied value of its technology. You will find discussions across Reddit and X, formerly Twitter, constantly pointing out this rising short interest, often calling it an indication of coordinated manipulation or a setup for a massive short squeeze. The reality for the retail investor is far more nuanced. You need to focus on 2 actionable pieces of data. First, the cost to borrow the stock has shown spikes, which indicates demand for short sellers is high, making the short position expensive to maintain. Second, monitor the fail-to-deliver data, which has also been elevated at times. These fails indicate temporary operational breakdowns in the settlement process, often coinciding with periods of high short volume and intense trading. For the retail investor, the prudent move is not to blindly chase a short squeeze based on online chatter. That is a pure gamble. Instead, use the short interest as a proxy for the level of institutional skepticism, but combine it with the fundamental analysis of recent product development and institutional accumulation. If the fundamentals start to demonstrably improve, the short sellers will be the ones forced to cover, not the other way around. Do you think the high short interest here is a reflection of smart institutional money accurately assessing the risk, or are they being overly bearish on a genuinely promising piece of technology? Comment below what your take is on the rising short interest, smart money, or a sign of an imminent turn in sentiment. The path forward for Rezolve AI plc is entirely dependent on its commercial execution in the first half of the coming year. The future outlook hinges on converting their technology platform and recent strategic moves into tangible, large-scale commercial contracts. Possible scenarios range from a major contract announcement with a Tier 1 retailer or banking partner that validates the agentic commerce concept, which would send the stock soaring back toward its all-time high, to a prolonged period of stagnant revenue that forces further dilution and a slow grind lower. The former would exceed market expectations dramatically. The latter confirms them. A significant catalyst could be the announcement of their next quarterly earnings, where the market will demand a clear operational update showing that the new management and acquisitions are already impacting the sales pipeline. The risk is significant cash burn. Losing tens of millions of dollars quarterly is not sustainable without consistent access to capital, which is directly tied to the stock price. The opportunity lies in the fact that the underlying market, the modernization of digital commerce, is undeniable. If RZLV captures even a fraction of that market through a successful partnership, the current share price would be seen in retrospect as incredibly cheap. This stock is a pure expectation versus reality play, where the expectation is a failing concept stock, and the reality is a deeply discounted technology infrastructure play with immense operational risk, but also immense potential reward. The next 3 months will determine whether the quiet institutional buyers are geniuses or simply early to a funeral.